Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, the dirty secret on Wall Street is that sometimes, most of the time, we're just as clueless as to the direction of stocks as everyone else. When excitement and hope can change to despair and sell-off on a single tweet, analysts and the financial media use these 5 lies and meaningless phrases to look like they have a crystal ball trained on stocks. And when that happens, you need to be ready to see through all the bullshit that passes for investing advice. So I'm counting down through the 5 ways Wall Street tricks you, so you're not going to let it detour you from your plan. Stick around, and I'll also update our stock market outlook, along with important news to shares of Uber, Rivian, The Trade Desk, and Walmart. But first, if you want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, look for the link I'll leave in the description below. These are the stocks I'm watching in major multi-year themes, with one of the picks up 100%. And the group up an average 94% last year alone. That report is totally free. You're going to see the first stock immediately, and they'll email you the full report with the other stocks. It's an easy way to support the Let's Talk Money community and see some of my favorite stocks to buy, so look for that link below. Back to our main topic though, and everyone loves talking about the next hot stock, the one that's definitely going to the moon, but here's the truth: Wall Street doesn't want you to hear that it is lying to you. In this 24-hour news cycle where clicks mean money, investing isn't about making you rich. It's about manipulating you with that hope and the fear. Nation, Wall Street has mastered the art of sounding smart while saying absolutely nothing, using polished phrases that trick you into bad decisions. That's why I'm exposing 5 of the most misleading phrases, 5 that are outright scams, the kind of BS that sounds helpful but quietly drains your portfolio. I'll show you the truth behind each, how to spot it, and how to invest smarter. And let's start with the most popular investment advice, but also the most dangerous: buy the dip. Likely one of the most overused phrases in investing, repeated anytime a stock falls even 0.5%. And the problem here is, what you're going to see in most of these, it is so vague that it does you more harm than good. It's just BS jargon so you can keep trading in and out of your stocks. Now it does sound smart though, and it is persuasive. It's just a quick dip, right? So take advantage of it before the stock shoots higher. But then the reason this is a trap is nobody ever says what a dip is, how much of that dip you should watch for, what happens when a dip becomes a drop. Investors here buy the dip, and they buy more stocks every day when the stock drops even 0.5%. That's fine in a bull market, but when that dip is something more, investors push all in and even start borrowing on margin right into the start of a bear market crash, and they end up losing millions. Avoiding this trap means doing more than just jumping at every dip in stock prices. Set a target on your stocks for a larger drop, maybe 3 to 5% before you go bargain shopping. Set limits to how much dip buying you're going to do before you hold that remaining cash for a bigger drop. Pick just a few stocks from your portfolio, only the very best you really like for the ones where you're going to buy that dip more frequently, so you're not chasing every stock lower. This next one is going to piss off the Buffett fans, but it's just as meaningless: to be fearful when others are greedy, and greedy when others are fearful. And of course, this is another one that sounds so smart, like it's the kind of stock market wisdom that is going to make you rich. The market can be a wild roller coaster of prices. If you were able to buy into the S&P 500 at the lows over the last 30 years when investors were panicking, and then sell when they were the most greedy, you would have turned a 10% annual market into a 15% bonanza. That is a difference of 16 times versus 68 times your money. But again, it is the details that Wall Street leaves out that makes this one so dangerous, because nobody ever knows exactly when to be greedy and when to be fearful. Over the decade from the financial crisis and through the pandemic, every single day, Wall Street was screaming that investors were being too greedy, that stocks were expensive, and nearly every year, you would have lost money by being fearful. There's a lot to be said for this idea of going against that herd mentality. It's one of my favorite strategies, mainly because I'm just an argumentative asshole, but also because it does produce that higher return if you do it right. Being truly fearful or greedy means managing your stocks, bonds, and cash in a way that lets you take advantage of those overbought or the oversold markets, but leaves room to profit even if you're wrong. If you think stocks are expensive and investors are being greedy, you don't just sell out of everything all at once. Take profits and hold maybe 20% in cash at first. If the market keeps going up, sell another 10% and hold it in cash or bonds. Do it in stages like this and have a formal approach for when you're going to buy and sell, not just when some market hack on TV says so. This next one is a favorite of Wall Street when the market falls: to buy quality stocks or quality companies. Nation, this could be the single laziest piece of advice investors will ever hear: to buy quality stocks. Basically, the expert is saying they don't know what the hell you should buy, but if you take their advice and you still lose money, it's your fault because you didn't buy a quality company. Folks, I'm going to let you in on a dirty little secret of Wall Street, one that I learned over more than a decade working as a venture capital and in private wealth management. Most of the people you see on TV, the experts, are complete morons. They've been trained on a steady diet of these investment quotes, and it's so much easier just to regurgitate the nonsense than to actually say something meaningful and take that responsibility. Now, part of this advice is just unsavable because, no shit, you should always be buying quality stocks. Whoever woke up one morning and said, I think I'll look for the next dog shit stock to buy today. But there are a few other things you can do here to give this advice a little more meaning. First, have an objective measure for how you define that quality, what you're looking for in the financial statements, or the ratios to find the best stocks to buy. I'll link to a quick 5-minute stock analysis video in the description to get you started. Also, don't feel like you have to jump in on every stock pick. Limiting your portfolio to only 15 or 20 stocks you really like is going to mean you're only in those quality names. Here's another one you hear in those uncertain markets, that the analyst is cautiously optimistic. This is the ultimate in trying to hide the fact that that talking head on TV doesn't have a clue of where the market is going. Basically, what this is saying is stocks could go up or down, but the analyst doesn't want that responsibility if they're wrong. And it's the ultimate safety punt because, hell, given enough time, everyone that's cautiously optimistic is proven right. Even if stocks fall the second those words are uttered, the market is going to eventually rebound and prove that optimist right. Now, the best thing you can do when you hear someone say they're cautiously optimistic, after you stop laughing anyway, is just to list out the reasons to be either. Lay out the reasons to be optimistic in stocks versus those bear market reasons, the near-term weakness, and then make a decision from that. And one Wall Street lie you're going to hear every year, that the analyst forecasting a turnaround in the second half of the year. This is all that game that analysts and pundits like to play called, I have no clue. This is where they'll take a position on the market, either positive or negative, but usually positive, and then give that conflicting position for more than 6 months out. Basically, it's just another meaningless hedge so they don't have to take responsibility for a bad call. If the market keeps rising, well, they were right, and if that second half weakness never appears, who the hell's going to remember what one opinion out of a dozen you hear every day? And if, on the other hand, that weakness happens earlier, so if stocks start falling before the second half, analysts can always say, well, I knew it was coming. I was just earlier than expected, but I did warn you. So for any calls on a market correction or a change, these need to have a time frame and be better defined. Hell, some of these are even going to call for market weakness years out into the future. But here to help you actually make money, you need to think about the risks and the alternatives to each case. Looking now at the stocks I'm watching this week, Uber Technologies, ticker UBER, could be giving a rare opportunity to pick up shares on 5% drop after earnings last week. The shares sold off despite beating forecasts for earnings with $1.9 billion in EBITDA on $42.8 billion in gross bookings. Better still, the outlook for the second quarter was also above expectations with a range to $47.2 billion and earnings as high as $2.1 billion. Now, analysts expect the company to post 14% sales growth this year and next, and for the company growing so fast, shares are not expensive at just 4 times on a price-to-sales basis. And what's caught my eye lately, though, has been the speed at which Uber is signing up partnerships to keep growing into the future. The company announced last week a partnership with Pony AI to deploy the China-based robotaxis onto its ride-hailing platform in key markets across the Middle East later this year. It follows another deal the week before to expand Uber's partnership with China's WeRide to enter 15 more cities globally, and the company expanded its partnership with self-driving Waymo in the US last year. Folks, Uber is quickly and quietly becoming the company that is going to take over public transportation and is going to be the first to win from self-driving taxis. Rivian Automotive, ticker RIVN, also disappointed investors when it beat forecasted earnings but lowered its 2025 vehicle deliveries guidance last week. The EV truck maker reported a net loss of 41 cents a share from a loss of more than $1 last year, while revenue grew at a 3% rate to $1.24 billion. The downside was that the company raised its capital expenditures forecast so that spending and then lowered delivery outlooks to 43,000 vehicles for this year, down from the previous forecast of 48,000 units. I've owned shares here of Rivian for just over a year, and while revenue growth of just 5% this year isn't great, the stock is trading very cheaply at just 2.6 times sales, and putting together recent news has me really excited about this stock. First is the company's giant stockpile of batteries ahead of the tariffs. While Rivian manufactures all its trucks in the United States, some components and critically the batteries are sourced from China and South Korea, so this stockpile is going to keep those costs down versus other automakers this year. More than that, with the stunning drop in favorability for Tesla, Rivian has launched its first nationwide ad campaign coming early next year and has already seen its own brand image jump. Last week's earnings unlocked another $1 billion in funding from Rivian's Volkswagen partnership, so cash funding is there. This one is growing into that per unit efficiency that took Tesla shares booming higher 5 years ago. The Trade Desk, ticker TTD, jumped 25% Friday when it reported revenue growth of 25% for the quarter and earnings that beat forecasts. Importantly, in the face of that fear over competition, customer retention remained at 95%, and the company saw good traction on its new ID 2.0 platform and a shift that replaces some of those browser cookies. This is one I've been buying aggressively since the February sell-off and built up a 2,500 share position, now at 14%, along with some of that hedged with a covered call strategy to protect from any further downside. Even with last week's pop higher, shares are a buy here as 25% revenue growth shows forecasts for just 16% growth this year are underestimated. The company is a leader in connected devices and advertising technology, a market with years of growth from $135 billion to take even more of the global ad budget, and this stock will continue to pay off. Walmart, ticker WMT, is going to be the stock to watch this week when it reports earnings Thursday. Shares have rebounded since the tariff-related crash, up 7% this year and 60% over the last 12 months. Now, the world's largest retailer is expected to report sales grew at just 2.8% over the last year. That earnings actually fell 3% to 58 cents a share. Full-year forecasts are still for earnings growth, but on just 4% growth in revenue. The good news, though, Reuters is reporting that after China's shipping to the U.S. plunged 60% in April, recent bookings have stepped up for the freight later this month as some exporters hope for a thaw in tariff negotiations and that renewed demand. President Trump said Friday that tariffs on China imports could come down to 80% from the current 145% rate as we kind of de-escalate this ahead of the weekend's initial trade talks. It would be a good start, but I'm going to be watching for what Walmart says about the damage already done and what could be coming when it provides full-year outlook. Giving you that bigger picture here with the Sector Spiders sector tracker, 6 of the 11 stock sectors closed higher last week with kind of an uncharacteristic mix of winners and losers. Normally, in these down weeks, you would expect safety sectors like utilities and consumer staples to do well, while those riskier sectors like technology and consumer discretionary fall. Technology and consumer discretionary stocks performed well last week as earnings continued to surprise to the upside. Consumer staple stocks underperformed, though, as companies warned that inflation would hit earnings in the coming quarters and not all those costs would be able to be passed through to consumers. Stocks in the healthcare sector were by far the biggest losers last week, with threats of tariffs on imported pharmaceuticals driving a 4% drop in the sector and double-digit losses in heavyweights like Eli Lilly and Moderna. It wasn't just the drug stocks, though, with 38 of the 60 stocks in the group falling. Year-to-date, the sector is down 3.5% and presents an attractive opportunity, with earnings expected to grow at a 16% annual pace this year, the second best earnings growth among the 11 sectors, and stocks in the sector priced at just 16 times expected earnings. That's versus a 10-year average valuation of 16.3 times price to earnings. Only one other sector, energy stocks, is trading at a discount to that long-term PE ratio valuation. The favorites in the group include Humana, ticker HUM, Intuitive Surgical, ISRG, and Medtronic, ticker MDT, while the healthcare select sector Spider ETF, the XLV, can be used as a broad sector investment. See the stocks I'm buying for the next 30 years, my forever stocks, free with the link in the description below. Or click on the video here to see why the next stock market crash may be less than 33 days away. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.